Let's get across some of the latest moves now in markets with Shawn Hickman. He's joining us from Market Matters. Shawn, hi, welcome.
Nice to be here, Nadine.
Last week you said that the banking crisis, before we know it, will be done and dusted. Have the moves been taken in the past week bolstered your opinion?
Yes, I think my exact phrase was, I actually went back to check it, so I remember you wrote the notes down, so I knew you'd throw it at me. I said in the next couple of weeks I think it would be behind us, and I think it will be. I mean, obviously it's not going to be vanished, but I think we're already seeing the Fed is stepping up, the ECB is stepping up, all the regulators are coming in to prop up the problems happening in the banking sector, and it's a big problem. I mean, these banks, not all of them have been as smart as they should be. They've gone out there and they've bought a truckload of treasuries. Those treasuries have now been hammered in value because interest rates have gone up, and they're holding on their balance sheet some massive, massive losses. I think over $600 billion US dollars at the end of last year. US banks are holding on their balance sheet. So by definition, the Fed's looking at that and they're saying, okay, we can't let this get any worse. We're going to have to go in and prop things up around the edges. Makes it quite interesting what they're going to do with the rates this week. Yeah,
it does. Certainly does. We've seen the Australian market really, holding itself below that psychological, I guess you could call it 7,000 level. What is this chart telling you, Shawn?
I think it's time for a rest. The last few weeks obviously have been pretty ugly. I think we'll see the market rotate between 69, 71 over the next couple of days. Hey, this is a volatile market. I think at the moment we're not discounting the possibility this market could go down and test 6,500. We put a bit more money to work over the last couple of weeks, as I did tell you when I've been in here. We think now we're not putting any more in. We're going to keep the balance of our cash and our gold holding, which is a quasi protection position. We're going to keep that in play just in case we see further weakness down to those lower levels. And this is not a overnight call. This could play out over months and months and months. But at the moment, what we've seen in the banking sector, we think the panic is going to be behind us quite soon. But that doesn't mean the banks are going to go roaring ahead as well.
Okay, so that's the ASX 200. You mentioned gold there. Let's take a look at the next chart, which is Newcrest Mining. Because the gold price obviously has been very well supported by all of this volatility, and then you get the Newmont, talk surrounding Newcrest as well. This chart looks as if it's gaining a bit of momentum to the upside.
Well, that's right. That's one of the reasons I put it in today. It's not all doom and gloom. It's all about stock and sector rotation. Last week we saw the Nasdaq have its best rally. It went up over 4%. Its best rally since last November. A lot of people are thinking the market's in free fall, I should say, because the ASX is under so much pressure because we're a banking index. But if you've been hiding or investing in the right areas, it's been good. Look at, as you say, look at Newcrest. It hasn't been up here for almost a year. It looks good. It's underpinned by the Newmont bid. We're long Newcrest, which is nice. Still not the perfect level we entered the stock at, but we think it's a good quality stock. I still think that will test $30 in the coming 6 to 12 months. But gold's around that 2,000 US dollars an ounce now. It's a big psychological number, to quote your phrase. I can see it having a rest around there for a while, but we're very, very bullish the gold sector, medium to longer term.
Got it. Okay, we can lose that chart and talk a little bit about, I suppose, what's going on in global markets. So I had some charts earlier on showing the S&P 500 relative to other developed markets, which actually did quite well over the past week. Part of that is the technology component of the indice, with the Nasdaq really outperforming, even comparatively speaking, to the S&P 500 over the past week. So bring up the chart, S&P 500 weekly index. You've got a big red line on here. What is that telling us?
Oh, that big, I think it's an orange line, but
is it? Okay.
that's where resistance is to us. That's where we got up to in the run into Christmas. We've come back again. We're looking back up again. But again, the reason I wanted to put that in there, last week the S&P 500 was up. So the regional banks had a shocker, the European banks had a shocker. Obviously Australia's far more correlated to the banking index and far more correlated to the UK and European indices. Because we're not such a big tech index, as you alluded to before, we don't follow US markets as closely. Last week, US markets were very volatile, but as this chart shows you, they closed up. And last night they were up again. So, we're still bullish the US markets. The FTSE doesn't look quite as pretty. I think if the FTSE can hold around here for a few months, it'll be quite encouraging. Now, I think it's going to take a while, as I said before. The big washout we've had in the banking sectors across Europe and across the US, they might stop falling, but I don't think that means they've got a green flag to run ahead.
Okay, so when we are talking about the banking sector, we can talk about US, Europe, Australia. Sometimes it feels like Australia, Canada versus rest of world because of the regulatory nature, the nature of our banking system being so different to that in which we see, that helped bring down Credit Suisse, essentially. What are we looking at here?
Well, I mean, let's just go back one step there, what you just said. The Australian press loves to knock the Australian banks. Everyone loves to knock the Australian banks, but I tell you what, it's times like this we should all take a deep breath and say thanks to the regulator and thanks to the banks, because we haven't had any problems here. Mm-hmm. They're strong, they're solid. And this chart just shows you the cost that is to actually insure debt to the respective banks. Credit Suisse has been in problems for 6 to 12 months.
Credit Suisse's share price was down 90% from the all-time high. I mean, writing was on the wall.
I think it was 94% over the last year. It's been horrible. And look at the cost to insure its debt. It's been really, really bad. It's been a problem basket case, for want of a better way of putting it, for quite a while. And I think that I might be talking to myself, hopefully not.
Not anymore, keep going.
But I think you can see there, the Australian banks, they're not doing too badly. There's no great volatility in the cost to insure their debt. Sure, they've been pulled back a bit, but they're not too bad.
But are you sort of lightening the load when it comes to the banks still?
No, we're slightly underweight the banks. We're not yet migrating up to market weight. We're certainly not going overweight, but I'm happy to be slightly underweight. We're holding ANZ, NAB and Macquarie Bank, as we alluded to last couple of weeks. I'm happy to be sitting in some banks. It is an underweight stance. That's good for now.
Okay, so when we think about some of the likely reverberations coming from the failure of Credit Suisse or the takeover of UBS, there's been a lot of talk about, AT1 bonds being wiped out, bondholders being wiped out. So do you think that we will see any interest in hybrids, for quite some time, even here in Australia?
Well, the word interest, absolutely. I could hardly touch the phone yesterday. It was so hot. Everyone was calling up people about what's going to happen to the hybrids. What do you think is going on with the hybrids? So the word interest, absolutely. Do I think it's going to slow things down a bit? Of course it will. But it's just when the opportunities are there. Some of these hybrids and some of the Australian banks, they haven't pulled back a great deal, but they're still great value. The banks look fabulous in terms of their safety, which means if they are paying a solid dividend yield through their hybrids, we think they're looking good.
Okay.
Just be very careful where you go.
Okay. All right. Well, we'll continue that conversation. It's an interesting one. Look, consumer discretionary. We came into 2023 saying, just be very careful. Some say don't touch it with a 10-foot pole. What has the price action as of late been telling us? I mean, when you consider, there are some now talking about a pause coming through from the RBA in terms of rate hikes.
I think the RBA might pause. I don't know if the Fed will. I think the Fed might still go this week, even though earlier in the week I was thinking it was 80-20 they wouldn't, and they shouldn't. There's a big difference between wouldn't and shouldn't.
Yep.
But I think they might send a message that they actually think the US economy and the US banking sector is strong enough to go 0.25.
We were talking about that in our morning meeting, if the Fed, and it's been brought up by guests obviously, it's not an original thought, but if the Fed does pause, that's saying a lot. That wouldn't be inspiring of confidence, let's say.
Exactly. It would make them say we're really, really scared, whereas 0.25 is a bit on the fence. And it means we certainly think things are okay in the banking sector, and if they're not, we're going to make sure they are going forward. So I think that's what they might well do. The market is swinging around like the weather, whether it thinks they will or won't, but let's wait and see. So coming back to your question, consumer discretionary, I've been talking about it on the show for recent months. I still think it's all too hard, leave it alone.
Yeah.
It's simple as that. I mean, we don't know how bad things are going to get when the mortgage cliff falls through over the rest of this year. 40% of fixed mortgages become variable this year, 20% next year. That's some big numbers of people that could see their average repayment go up to 30% higher. That's a lot of money out of their pocket. That's money that they would have spent on consumer goods. So if in doubt, let's wait and see how bad it is. But if we get a huge aggressive sell-up on the back of it, opportunities will be there.
Okay, lucky last as far as the charts that you've brought with you today. Shawn, you've spoiled us. REIT. So the REIT sector was the worst performing yesterday. Well, I don't know. Is this looking too bad to you?
It's a bit the same. We don't really own a great deal in the real estate. We own Goodman Group, not from a great level. It's a great company, but it's got brought down by both the tech or the revaluation in the growth stocks and the property sector. But this is one of those areas where we're sitting back. We're saying if they get really stuck into property over the next 6 to 12 months, we think it will be great value. There's a lot of stocks in here already trading well below their net tangible asset. There's a lot of stock in there already building into some really, really bad news. So when this turns, it will be really, really good. So we're not in there yet in a major way, but it's on our watch list. We've got cash, as I mentioned before. Yep. I'd love to be buying that 10, 20% lower.
And do you think you could get it 10 to 20% lower? That was going to be my last question, because everybody now, it feels like, is trying to time when the bottom is in, time when to get into this market. That's a bit of a fool's errand, isn't it? So when you say could get it 10 to 20% cheaper, that's implying that you think that's likely, at least for the A-REITs.
Oh, no, it's not implying that. It's saying, I hope it is.
Okay, all right, yeah.
But I think that you've got to weigh up the risk reward. It's just right here, right now. We've had a bit of a chicken and egg situation. We thought the banks could get into trouble if the property market unraveled. What have we had? The banks have actually unraveled, and the property market, it's only down 10% in Australia, give or take. It's not a big deal compared to where it was pre-COVID. So I'm just saying, I don't think it's a sector that's going to roar ahead in a hurry. So we can be a little bit patient to see what happens. Do I think we'll get it down there? 50-50, maybe, maybe not. But it doesn't hurt to be patient just in case.